communication?
Kurt, are we live?
Yeah.
I'm showing
You're
that
live.
it's okay. Perfect.
Yes.
Okay, so call the meeting to order. First item on the agenda is, has there been any communications to the Council of Public Comments?
No.
Okay. Okay, why don't we give it about 30 seconds or so to see if anyone has any comments, raises their hand, or sends us a chat. Oh. Hey, Boris, is there any comments? Or
I don't see anything. So there's a Q question and answer section, and there's also a webinar chat.
okay.
So we do invite the public to.
There's also someone can raise their hand too, right?
They can raise, yeah, they can also
Okay.
give verbal comments.
So I see no chat, no one raising their hands, nothing in the Q&A. Okay, so I see no public comments. Okay. Next item on the agenda is the minutes from our council meeting in January. Any discussion on the minutes?
I'll move to approve.
Okay, any second?
I'll second.
Okay. Vice Chair?
Aye.
Okay, Dr. Bonham?
Aye.
Okay, Councilmember Hayashi?
Aye.
Councilmember, oh, sorry, I'm sorry, I skipped you, Dr. Bonham. Dr. Bonham?
No, you already got my vote. Aye.
Okay, aye. Councilmember Hamasu?
To you, Mike.
Oh, aye.
Councilmember Bennett?
Aye.
Okay, so the minutes are approved unanimously. Okay, thank you. Okay, next item on the agenda is Dr. Beamers' presentation.
Okay. I have something very brief just to share some of the latest revenue numbers and to put things in context, and also share your current official forecast and the model results. So let's get started. You're able to see my screen?
Yes.
Yes.
Okay. So as you know, the major sources of tax revenue are, the first one is general excise tax, about 40% of state tax collections. And next one is individual income tax, about 30%. And what the very next one is, at this point, a transient accommodations tax, which trails by about 7% of tax collections. So those are the three major ones I'll be talking about. The year to date, for the first 8 months of fiscal year 26, the GET collections were up by 5.8% compared to the same 8-month period previously. Last year, GET growth was 3.3%. One thing of note, as you know, as of January 26, well, okay, that doesn't apply to the GET. I'll mention there's an increase in the TAT rate as of January. But
So weren't there also some exemptions that went into effect for the GET?
They did. Yes. So there are some exemptions, but overall there's some healthy amount of growth for at least 8 months of the fiscal year 2026. Next one is individual income taxes. We've been talking about this for a while at this point.
I have a question.
Yes,
so
please.
Today we saw the 5.5 GT growth. So this is as of the end of January that this chart is showing 3.3.
No, it's through the end of February.
So it's through the end of February. 5.8% is through the end of February.
Okay, because our preliminary was showing 5.9.
Yeah.
Right. So clarification. So the preliminary only measures general fund collections.
Right.
And this is not general fund. This is total general excise tax collections. This is
What?
also, in answer to Carl's maybe a question earlier, where so we should not. The preliminary is not to give. It is there to give you some idea about where things are going, but it only pertains to the general fund. And what we measure normally is the total collections, and that's what we look at. We monitor the total tax collections. So part of it has some, special fund allocations. Part of it has, tax administration funds. There are various details that go into it. So that's why there will be slight difference between those percentage points as well.
Yeah, I don't understand. I still don't understand.
Yeah,
You-
I mean,
Why the daily is 5.9? I mean, the monthly is 5.9 at the end of February, and then this is showing 3.3.
right. So it's two different things, right? So one is only the general fund portion of general excise tax in the preliminary report.
Oh, I see.
Yes.
Okay.
So this
The
is the
general fund.
total
Strip out
general
the-
excise tax collections.
Strip out the county surcharge portion then.
No, not the counter surcharge, but the total GET collections.
What
So
else?
there, I mean, we can, in the annual report, we break down every single tax. I mean, I can give more details next time if you're interested. I've given a presentation last month to the Tax Review Commission about all the various taxes and different fund allocations and so on and so forth.
I'm not, in all my experience, I'm not aware that the general G is other than general fund, except for the county surcharge portion.
There's a tax administration fund aspect of the GET. Right.
But does that account for 2.6%?
No,
It's
it's
not
not.
2.6. That's the number on this slide for fiscal year 25 is for the entire fiscal year, not
Well,
year to
I'm
date,
sorry.
right?
Yeah, I'm looking at the wrong number. I'm sorry.
Yeah.
Okay.
So this is actually a negative 5. It should be a negative.
No, it is positive 5.8% GET growth for the first 8 months, July to February, the 8 months of fiscal year 26, compared to the first 8 months of fiscal 2025. So year to date, 8 months compared to the same previous period in the previous fiscal year, the growth rate is 5.8%.
Okay, I see. I was looking at the wrong line. I'm sorry.
So what Christy was asking is that, the percentages will be slightly different because of, you're comparing different base to a different new number for that reason, but it will be something relatively similar. So in terms of the individual income taxes, we're down by 8.7%. Again, this is looking at the first 8 months of the fiscal year to date. From July 25 to February 2026, compared to the first 8 months of the previous fiscal year. As you can see, the Act 46, the individual income tax cuts are weighing down on the overall collections, but it remains pretty much within expected bounds. So the preliminary report, we've shown that the year-to-date collections were down by 184 million for the first 8 months, and the tax. Our office had projected about 600 million reduction in individual income tax revenue as a result of this bill for fiscal year 2026. So at least for the first 8 months, we just saw only 180 million reduction. Of course, we will see the March and April numbers, and that will probably be a little more negative as well. Now, in terms of the transient accommodations tax, this is what I was referring to. So as of January 2026, there was the green fee, the environmental impact fee. So there's an increase by 0.75%. So the TAT collections are especially up for January and February. Overall, for the first 8 months, TAT collections were up by 4.1% compared to the same period last year. General fund, just to remind you, remember last fiscal year 25, we had 4.2% growth, but that was mainly due to that one-off boost to the estate tax collections by about 315 million in September 24. If we were to remove that, the growth would be pretty much flat in fiscal 25. And what is happening so far, as of February 26, the general fund is down by 5.4% compared to the same 8-month period last fiscal year. So if you may remember, previous month was negative 5.5%. So this number keeps going down. And even if we have 0% growth for the remaining 4 months of the fiscal year, we would end up with negative 3.7% general fund growth rate by the end of the fiscal year. And if you were to remove, just to give you, the magnitudes, the estate taxes, let's say it never happened, that one-off boost never happened in fiscal 25, then the general fund growth to date would have been negative 0.6%. And that negative number is mainly from the individual income tax cuts. Otherwise, as you've seen, the GET collections are up, TAT collections are up. The main driver here for the negative number is the individual income tax cuts. This is as you know, your official forecast from the last meeting, which was kept the same since the September meeting. It stands currently at negative 4.7% for fiscal 26 and hovers around 2% for the next next 4 fiscal years, and then the last 2 fiscal years it's around 3%. Now here are the results for the official forecast from January in comparison with the model forecasts. So the model forecast is more negative overall for each fiscal year for the out years. Just to remind you, what the model does is it basically takes your, runs historical regressions. So it runs everything from the 60s up to 2025. And then we take your the mean forecast of main economic indicators. We use that and use the coefficients from the regressions to project, to obtain the model forecast based on your projections. And also, for future, there are adjustments for tax law changes are also made, and that's how we get this number. So the negative numbers are in reaction. The more negative numbers indicate that compared to last time is that the input mean forecast was slightly more negative for the main drivers. But this is all I have for now. I mean, I'm happy to answer any other questions. I just wanted to keep it brief, and the discussion is, from you basically. But I'm happy to answer any other questions. Thank you.
I have a question, Baibars.
Yes.
You made a comment that I think we're currently down, the general fund currently is down, is it
5.4.
5.4%?
Yes.
And last month it was minus 5.5. So as we keep moving out in time, come the end of our fiscal year in June 30th, if we were dollar to last year, the annual growth rate would be minus 3.5%. Was that what I heard?
Minus 3.7%.
Minus 3.7.
Which is close to the estate tax, one-time estate tax payment, right? The 350 million in fiscal 25.
Thank you.
Thank you.
It was 315 million in
Yes,
fiscal
correct.
25.
Correct.
Yes, it's a little bit more than 3 points then.
I mean,
Because-
yes. I mean, overall incomes grow as well. So although the tax rates go down, so remember these are nominal.
But- But also the income has gone down too, right? Not just the tax rates.
yes, the collections, the income tax collections have gone down, but I don't think the income has gone down. So the personal income has actually gone up.
Yeah, I mean, the withholding went down from 1.9
The
to
The
1.7.
withholding did go down by design. We changed the withholding tables January 25, and now we changed them again in January 2026. So taking into account the increase in standard deduction and also the change in tax brackets.
Yeah, but the standard deduction shouldn't affect the withholding. That's like
It
tax return.
we did adjust them to take that into account.
But is the wage level still the same? The wage level from year two?
The wages have gone up.
Okay. Okay. Very much, or
I don't have the exact number, but Carl, do you have?
Yeah,
Could you have them?
it's let's see, well, calendar year wages in 2025 were up 5 and let's see, let me get the right series here. Oh, that date, never mind, that data is completely messed up. Missing a whole bunch of data here. And if you look at total labor earnings, that's probably the easiest way instead of trying to look at wages. So earnings by place of work through the third quarter of 2025 are up 5.6%. So the third quarter is the only data we have for this fiscal year, and it was up 4.4% in the third quarter of the year. We don't yet have fourth quarter data.
so through third quarter of 25 was still pretty strong.
Yeah, I mean, you know, inflation at 2.5%, that's a 2% real, and that's basically all labor earnings.
Bars. In the preliminary forecast that we got, or preliminary numbers that we got, it's showing that there's a large decrease in corporate income tax of about 76 million. Was that from lack of estimated tax payments, or is that refunds?
Refunds. They were basically refunds. So overall, the corporate income tax collections are down across the nation, and our numbers are pretty much in line with, like, the downturn is very much in line with what we observe nationally.
It tends to be very volatile, the corporate income tax base over the years, but the estimated payments are slightly down, 285.
They are also down. Yes.
305 million.
So should we take that as an indicator that the economy is slowing? I mean, or basically the businesses are not doing as well, or?
You look at the individual estimated, they're also down from 507 million to 477.
In the case of individual, I think that reflects the tax cuts. So people are adjusting, realizing, the tax rates are changing. So
it's based a lot on profitability too. So proprietors, partners and S Corp shareholders. So it is.
It bounces around from month to month all over the place.
Yeah.
And it's a pretty small number typically. So the growth rates can be enormous, but the impact on the general fund tends to be relatively small.
Yeah.
And it reflects not only profitability, but any kind of change in tax strategy.
In Bibars, correct me if I'm wrong, I think you mentioned that the refunds could take some time, right? Because if it's based upon an audit, if it's a large refund, it gets held up. So the 80 million or $76 million may not be attributed to even last year. It might be a year before, even before, right? So it could be from any period of time. So it's kind of, to Carl's point, it bounces around. So it's not really necessarily that strong of an indicator one way or another, right?
that is correct.
Yeah, I think the refunds,
That is my
but the
understanding.
estimated payments is some indication, but it's not definitive for both individual and corporate.
Bybars, could you send us the presentation that you made?
Yes.
Thank you.
Okay. Well, thank you, Bebas. On fiscal 2026, anyone want to start us off besides Carl, or we defer to Carl?
Please.
Oh, okay.
Take it away, Christy.
Well, I don't know. if I have much to say, but I put in my forecasts because I was traveling before we got the latest visitor information. And of course, the spending numbers came in very strong. Um, I'm, I'm pleasantly surprised, maybe is the wrong word, but the fact that we're doing better than I had feared. So that is a good thing. The world is so crazy right now. It's really hard to know if people are going to be affected by, travel. TSA is now working as well. Are we going to have an impact from that? We have less of a wealth effect, depending on the hour, due to the stock market. So that I think all this volatility is making people a little bit more nervous. I'm not sure what that translates into dollars and cents as far as what we've collected, but I'm a little bit more optimistic based on the numbers so far. So thank you to the tax department for being able to provide the preliminary numbers to us through February. It's helpful.
And we don't have any data for March yet. I'm sure it's way too early for that. Is that
That's
right,
right.
Daybars?
That's
Yeah.
right.
Sorry.
And
Okay.
as you were indicating, Baibars, the March and April numbers can really swing the income tax numbers for individuals. So we've seen that those numbers can be really, really strong,
Yeah.
or much different than what we expect. So, yeah, it'll be interesting to see. I haven't done my taxes yet, so I'm not sure how my numbers look. But with the change in the tax brackets and the deductions and all, it's of course makes it a bit harder, I think, to predict.
Yeah, I mean, the one good thing is when we did the revenue estimates, obviously we have access to all the tax return data, and so that makes it as good as it gets in terms of the estimates we make, and our estimate was about $600 million reduction in individual income tax collections. So
We're
far,
at 180 right now.
You're at 180.
So we're in pretty good shape there.
Yes, it seems like that to me. So it's going to be within balance, is my expectation.
So we have one data point. We have the February refunds at 136 million. That strikes me as not particularly out of line with what you would expect for a February, because that's one of the areas where we're going to be watching a lot, obviously, for during tax season. I know it's still a little early, but people are filing their taxes.
Right. Yeah, the ones that file early are the ones typically who are filing for refundable tax credits to take advantage of those. So definitely.
Papers, when did the last tax brackets take effect? For what tax calendar year?
It took effect tax year 25. So when people file their returns, they will be getting bigger refunds, but also the withholding has gone down.
Yeah.
So
Also, estimated payments would also probably come down.
But if the estimated payments were not adjusted, they would get a bigger refund this time around.
Right.
But typically when you do your your extension or tax returns, you adjust your estimated payments based on, the current rates.
Okay. Yeah, that is my feeling. That's why the estimated payments are also in line, like they've gone down.
But the estimated payments were only made for, I see. Yeah, you're right.
For
The
tax year 25, yeah.
Calendar year 25.
So we're kind of in the weeds a little bit, and important weeds, but I wonder if I think a good way to approach this might be, one, to think about to the extent possible, think about the economy and where things were before our efforts to raise oil prices and gasoline prices, and then to consider the turmoil that's happened since then, because in our last meeting, I think we were all a little bit more optimistic, partly because the increase in tourism spending that happened in the second half of last year was, it was pretty marked considering how weak the visitor numbers, the arrivals numbers were. And I mean, we did way too much work trying to figure out if that was actually happening, and wrote about it in our last forecast report. And our last forecast report was more upbeat, I think very consistent with the way the council was feeling back in January. What appears to have happened last year was basically wealthy travelers unleashed their wallets in Hawaii, just like they're unleashing their wallets on all kinds of consumer spending nationally. Right? I mean, the estimates that I've looked at tell me that well over half of all consumer spending in the country is due to the top 20% of the income tax bracket. And if you look at Hawaii, the only accommodations that saw strong revenue growth last year were the high-end properties, basically what are called luxury or upscale luxury properties. Everybody else, the middle and below, we're seeing declining occupancy rates, declining prices, and declining revenue. But the top of that market saw some pretty strong growth. And so anyway, our interpretation is that we're feeling the same thing that the rest of the country is feeling with high-end consumers spending. And then we get the January data point, which honestly, I don't really believe it. I mean, I've asked about it. I would call that an outlier, and we're still trying to figure out whether it's real or not. But even if you discount it by 50%, it's still a really strong number for arrivals and for spending. And so I actually ran our Nowcast model that uses monthly. It uses actually the daily data on passenger counts. It uses the Seats Outlook data. It uses whatever visitor data it has. And with that January data point, that the Nowcast flipped from roughly zero growth in arrivals for the first quarter to high single-digit growth for the first quarter. So I guess I would characterize this as that this is a little bit of a continuation, even if you think it's partly an outlier. It's a little continuation of what happened at the end of last year, which was a pretty strong tourism numbers at the high end. And I think that at least until the data for January, it's actually the February excise report, excise taxes reflect January activity. And so I'm a little bit puzzled by why we didn't have even stronger excise tax collections in January, if those tourism numbers are right. But what we've been seeing is better tax revenue growth than we thought. A little bit better, not markedly better. And I'm actually ignoring all the other noise for right now. I would be completely comfortable with either the forecast we adopted last time, which I think was minus 4.7%, or maybe even a little bit stronger than that, like minus 4.5%. And then now that's all before you introduced uncertainty associated with the war in Iran. But in a large part, I guess I would characterize that as just uncertainty, right? We really don't have a clue. And we could do scenarios, right? There's no scenario where it's I don't think there's any scenario where it's a net positive. But if it literally ends next week, then the measurable impact will be so small that I don't think we'll be talking about it in 6 months. If that's the unknown, is we don't know how long it's going to last, and we don't know if it's going to get worse in terms of disruption of energy supplies.
Carl, what do you make of the jobs number, the loss of 92,000 jobs?
It's look, I mean, the month before we had 130,000 before revisions, and now we have minus 92. If you look at the last 3 months together, I think they average around 10, maybe 15,000 jobs at most. Well, that's roughly last year we averaged about 10,000 jobs a month. After the revisions that happened in December, you look at the whole year, we averaged about 10,000 jobs a month in the US. And that looks pretty close to what we've seen for the first 3 months of this year. So, I mean, my take is the US economy's basically not adding any jobs. The labor market's effectively stalled. And, so you have this sort of dichotomy of strong GDP growth that's, very much still being driven by AI investment and high-end consumption. And then you have no job growth, which is at least in part because there's no one to hire, right? Because you've put a clamp on migration, and people are aging and so on. So the labor force is kind of going sideways. So we really only need to add probably 20,000 jobs a month to keep the unemployment rate stable, maybe a little bit more than that. So if we keep adding 10, the unemployment rate will keep edging up. And yeah, so I mean, I don't really look at anything as having changed fundamentally in the labor market in the last several months. It's so noisy. You really have to do 3 or 6 month averages and go from there. And based on that, I'd say we're kind of in the same ballpark we were in at the end of last year.
I would add that certainly the markets, the Fed, of course, the FOMC is looking at both inflation and unemployment, and I think that concern about the two things are inflation really is not improving. Maybe it's a skosh, but it's really not improving dramatically. And that concern about the labor market, because certainly it is weak. And as Carl was alluding, our productivity numbers look strangely high. So it puts the FOMC committee in an interesting place. Right now, the futures markets are anticipating 1 and maybe 1.5 cuts, 25 basis points cuts in the next year. Well, you go back a ways and it was 3 cuts. So certainly it's a very interesting position with both of those things kind of counteracting each other. And Powell did come out and say, basically, they are on hold. They are not paused on their way to somewhere. They are on hold. So
Yeah.
that's a different connotation.
Mm-hmm.
Certainly that I'm just looking at the 10-year because I focus on the mortgage market. It's back up to
4.1.
415 this just now. So it's really come back, and that, of course, the lower that rate is, the more activity we see in the mortgage market. So that is reacting to this idea that maybe they're not going to be lowering rates as fast.
So long as you don't start seeing more layoffs, right? So we are really still in a no hire, no fire job market, and my sense is the Fed's okay with that, and it kind of makes sense given what's happening to labor force, and some of the uncertainty from 2025 is maybe a little bit diminished, not much given the sort of continued chaos around what tariffs will be next, and so yeah, in our forecast, the next Fed rate cut is September, and that's in part because of changing leadership, but it's really not. It's not mostly about that, and of course all that's everything's up in the air with how long the disruption to oil supplies lasts. Yeah.
The oil impact is enormous, and it trickles through, and it affects our economy.
So wait a minute. It's only enormous if it goes on for another for a period of time.
It can be.
Yes.
But I wanted to get back to our 2026 forecast. So we have about 8 months of data in hand, if I understand that correctly. So really, we're just forecasting the next 4 months, which we're halfway into one of the months now. So, I mean, some of the impacts that we're discussing, I full-heartedly believe we're going to have some consequences from, but maybe not till the next fiscal year. There might not be imminent associated with that. So there's comments that I've heard Christy make and Carl make, and observations from BIBARs that I wholeheartedly agree with. And mainly it's that the GET component continues to be strong, and the TAT continues to be strong, and it's been more than adequate to offset the income tax reductions that we're experiencing in both categories, personal and corporate. And so it's, when Carl mentioned our negative growth rate for 2026 being minus 4.7, it did feel to me that maybe it was a little too pessimistic. And so I would be comfortable lightening up on that somewhat at this go round, particularly because we're so close to the finish line.
Well, and keep in mind that the reason why we're negative is because of the $350 million estate tax that we received last fiscal year. So year over year, we're about break even. Yeah.
Yeah. I think you said BIBARs is 0.6 without the refund, right?
Correct.
Yeah. I mean, not the refund, but the big estate tax payment.
Right.
BIBARs,
go ahead. Go ahead.
sorry, BIBARs, just one other question. So the green tax on the cruise ships, that's not currently reflected in any of these numbers, right?
No, they're not. But that was relatively small, as I presented last time. Yeah.
Okay.
That part was relatively small.
Point.
Yeah.
Marjorie, go ahead, Bob.
But it didn't affect the percentages, like, because just like in the ballpark of $10 million was the estimate.
Wasn't it 80-something million to BIBARs?
That's the total impact, but we kind of segregated the cruise ship aspect from the regular TAT increase by 0.75%. So the big chunk of the revenue impact is from just the increase in the TAT rate.
Oh, the 1 point, without 1 point, right? The TAT rate.
Yeah, without the imposition of TAT on cruise ships. Just the new thing.
And that green fee for just a normal tourist is in effect. That is reflecting.
That is in effect.
Okay.
Yes, as of January 1st, 2026. Yes.
Councilmember Hamasu, what are you seeing on the real estate side?
Well, actually, kind of reflected what was discussed, is that the commercial real estate markets in particular have remained fairly stable. I mean, there are significant concerns regarding construction costs related to development, but from a leasing perspective, we're seeing more stability than we had anticipated and going into the year. Investment transactions, with a couple of rate cuts that have transpired, where we ended the year fairly optimistic. We showed a second year of consecutive increases in investment transaction activity here in Hawaii. Mind you, it was the first time in a number of years that we had multiple what we call mega deals, which are over $100 million in sales price. So, as you all mentioned, it seemed more optimistic heading into 2026. Now, with that, I kind of looked at some historical stuff with the 1970s oil embargo and the Gulf War and all that stuff, and how it negatively impacted the economy going forward because of the rise in inflation and maybe potential impact on tourism. So when you're talking TAT tax, that's all tourism related. So, there might be a sizable slowdown depending on, as Carl mentioned, how long the current war continues. So, I'm in agreement with Marjorie in regards to in the immediate next couple months. I don't think there's going to be a significant amount of change, but if the war continues into March, April, May, then our markets are going to be significantly impacted by probably a decline in tourism and rise in inflation because of the cost of oil in our market.
Bibers, in your presentation, you said that if we had averaged 0% for the last 4 months, what would we end up at?
Negative 3.7.
3.7. But that means over the last 4 months, we're going to be 0 versus the 5.8 or versus the current negative for the first 8 months on the
Right.
general fund.
What I meant by 0 is like year on year 0. So like, let's say March of 26 is the same as March of 25. April of 26 is the same of April of 25. If that is the case, then we would end up at negative 3.7.
But year to date, we're negative.
Year to date was negative 5.4. If we stay exactly flat, that number will keep going down with each passing month.
But that means the last 4 months will be stronger than the first 8 months. It would be 0 versus
Not necessarily. I mean,
No, they don't have to be stronger. Even if it's flat, then we end up at negative 3.7.
Flat
If
is
they're
stronger.
stronger, we would end up at even a smaller number.
But flat is different than the first 8 months.
So Kurt, I
Yeah.
think the major contributor to
Yeah.
the current negative 5.4% is because of that estate tax anomaly that happened.
Yeah.
So if you take, as Christy mentioned, if you take that out of the equation, just pop it out, we're very close to dollar.
Yeah. We're close to even. And I understand the negative will get amortized, so it's going to be decreased because it's going to be stretched out over 12 months
Right.
versus 8 months.
Correct.
But still, I guess we're projecting a nominal rate, right? So we still have the 315 million less in estate tax payment in the general.
So the question was, if we were at 0 for the rest of the fiscal year, then that would be stronger than what we've experienced year to date.
Yeah.
But these are year-over-year numbers versus a year-to-date number that you're referring to, the 5.4. If you look at the start of the fiscal year, from July through October, each month the year-over-year numbers were negative. Okay, and then starting in November, and I'm looking just at the numbers that we've pulled from the preliminary reports for the total state general fund. Starting in November, those numbers started to be positive. So the November year over year was 1%. The December was 6.3. The January was 6.6, and I'm not sure what the February would be.
Slightly negative.
Slightly negative for February.
Year.
So in real, I mean, if you look at just say let's say you looked at the rolling average of 4 months, and it's kind of hard to do because the tax revenues come in at different times during the year, but the moving average of the last 4 months would have been positive, and so adopting a 0% growth rate for the next 4 months would be less growth than we've experienced recently. But again, I mean, the wild card. Look, something that we don't know what's going to happen with the tax season, right? And the tax season can easily swamp
Everything.
0.5%, a 1%, right? It can change everything. And so if people adjusted their withholding, I mean, I know tax did that for some people. If they adjusted their estimated taxes and the refunds aren't enormous, then I think there's a decent chance that this year's tax, April, May, June will be stronger than last year because of the growth in the economy that started really ramped up in the second half of last fiscal year.
Mhm.
I also now, I kind of remember the estate tax hit the very early part of the prior fiscal year.
It was September. I'm pretty sure it was September of
Yeah, so-
2025.
September 24. Yeah.
Yeah, right.
So that effect gets diluted over the.
Right.
over the
Exactly. Yes. Yeah.
Okay.
So Mike already, chimed in kind of an agreement with Marjorie, and I think Marjorie's right that a lot of this, in terms of the biggest impacts, will be are most likely to be felt in the next fiscal year, assuming that the war goes on for an extended period of time. Again, if most of the hostilities end in a week, then I would say we're not going to see much of an impact. And then the flip side is that in the near term, and we really haven't seen increases in gasoline. I mean, we've seen small increases in gasoline prices locally. Even those you would expect to happen, a month or 2 months down the road, just because the oil that was being used to produce those, is already here. It was bought under a different price regime. But where you might see an impact is if we start seeing the cost of energy items here go up, that actually has the potential to raise tax revenues through the fact that you're paying the excise tax on the nominal value. And so if we get a little bit of inflation, it could actually have a small positive impact in the near term. Because people will not immediately adjust their consumption downward because of higher gasoline prices.
So do we have a proposal for the current do we have a motion for the current fiscal year?
Throw out a number, Carl.
4.5.
4.5, a little bit better than where we are at. I would be comfortable with that.
Negative 4.5.
Yes. Thanks for the
Yes.
clarification, Councilman.
Good clarification, Marcia.
Any second?
I'll second.
Any further discussion? Okay, no further discussion. We'll take a vote. Vice Chair Maynard,
Aye.
Dr. Bonham.
Aye.
Councilmember Hayashi,
Thumbs up.
Aye.
Councilmember Hamasu,
Aye.
Dr. Bennett.
Aye.
So the motion carries unanimously for negative 4.5 growth rate for the fiscal year 2026. Okay, next item on the agenda will be fiscal year 2027. Okay, anyone want to start us off? Carl?
Yeah, I guess my inclination, I hate to do this, but my inclination would be to leave the forecast unchanged. And in the letter, recognize that the uncertainty that's being created, basically, we'll have another chance at that next fiscal year in May. And I know that's not very satisfying to the ledge, but I think it would be a mistake for us to lower the forecast or raise the forecast much at this point, based on a couple of weeks of oil price volatility, and when we really literally have no way of knowing if the fighting basically stops in a week. I mean, oil prices will come down quite rapidly once the strait reopens. And that's not going to be immediate, right? Because there has been a stop of production because of no capacity to store.
No place
But
to put it.
if you look at what the futures markets are saying about oil prices, they come down pretty hard. You don't have to go very far out for them to start coming down. And I actually think the futures prices there seem pretty reasonable in contrast to futures prices on Fed funds or 10-year bonds, which just seem to be totally all over the map. So, yeah, my inclination is we don't change anything and try and express the uncertainty that's being created in the communication.
When would be our next general fund
Toward
forecasting?
the end of May, usually.
Yeah,
I think-
May.
So
End of
next
May.
reporting day, is it June 1st or June 10th? I forgot.
The reporting date is June 1st. We
Okay.
typically try to do it before Memorial Day. It's been around somewhere in May 21 to May 25, sometime around that time period, I
I
think,
think
in the
we've
past.
had a little bit later, but then they push us.
Sometimes a little later, yeah, depending
Depends
on,
when Memorial Day falls.
yeah.
Yeah, it falls on the 25th this year.
Yeah, so this year it's kind of early.
So it is a week before it's due. I know how much Buy Bars likes to scramble.
So if you think about, suppose that there was no war, suppose that hadn't happened, then we would probably be talking about raising our forecast a tiny bit, right? I don't think there's any reason why we would be lowering next year's forecast. We probably would be talking about raising it, I don't know, 10, 20, 30 basis points, just like we raised the current fiscal year. And remember, there's one of the reasons why we're a little more optimistic is because the visitor spending, but also there's the tailwind of U.S. fiscal policy that's, people are going to be getting bigger federal tax refunds. That's pretty well known, and they're going to be going out and spending it. Now they may be spending it on gasoline, but anyway, I guess we probably would have been raising our forecast. And so one way of looking at it is by not raising our forecast, we're at least incorporating a little bit of the uncertainty into that biennium, and that's probably the best we can do.
But just as to your point, Carl, if we have slightly raised our forecast for this year, and we do the next year's on a percentage basis, they will be slightly higher, right? On a dollar basis going forward, just the math of it all.
That's right.
We've done it both ways. We've tried to forecast dollars and percentages, but I think we feel most comfortable with the percentages.
I had a historical question. And and I'm asking Carl this because I don't have any idea, but in terms of these conflicts in the Middle East, have any of them lasted longer, or have any of them been shorter than a week or 2 weeks or 3 weeks?
Well, shorter than a week or 2 or 3 weeks.
Well, I mean, you're saying that.
I don't think so. Maybe a better example is what happened to oil prices after Russia invaded Ukraine. I don't know if I'm not sure that's a better example. Their oil prices actually came down, I would say, reasonably quickly. I don't know how you compare this to previous crises, because look, there's competing incentives here, right? People are already talking about the taco trade, and what that would mean in this case is if oil prices spiked to 120 and stayed there for a week or two, and national average gasoline prices were approaching $4 a gallon, then the war would be over, because the administration would say, we can't do this, and pull back. So they have an incentive to end this thing from a let's get reelected incentive.
Yeah, midterm elections, exactly.
And the longer it goes, the worse their position becomes in terms of rising prices. And so that's the primary thing that tells me that it could end quickly. The caveat to that is that just because the U.S. decides to stop dropping bombs doesn't mean that Israel will, and it also doesn't mean that Iran will stop lobbing bombs at oil refineries and and stop trying to keep the strait closed, right? It's not like we get to just decide, flip a switch, the war's on, the war's off. But that's just, that's the uncertainty. We don't know how long this is going to last. I'm betting that it's going to be shorter than, I haven't actually we haven't taken a position yet. We haven't built it into our baseline yet. But I'll be surprised if come April, we're still confronted with, say, the Strait of Hormuz being completely closed.
I think the U.S. is a little better off since we now produce more oil. Isn't that the case?
Well, that just means that producers are making a windfall, right? It doesn't, it doesn't. I don't think it means that they're going to be out drilling a bunch of new holes in the ground because of a conflict-driven spike in energy prices, and it doesn't change what the average consumer of oil-related products is going to pay at the pump just because we produce it, right? The producers of U.S. oil are going to be charging the international pricing for oil, and so they're getting a windfall, but the consumers of that energy are going to be paying it, and it's very, very different than the 70s, right, where we were not the world's largest oil producer. And it was everything about it was a net negative. And then we're just a flat out much less dependent on oil, on energy, period, in terms of, if you look at the relationship between GDP and energy consumption, that relationship has changed dramatically. So we're much less energy dependent than we were in the past. Nationally, okay? Hawaii hasn't seen that same kind of improvement. We've seen some improvement, but not the same as nationally.
Although,
Have we released reserves at all yet, United States? Has it
no,
gotten
they're
there?
talking about it. I suspect that if they do, it'll probably be something that's done in collaboration with other nations' reserves, because that's how you have the biggest bang for the buck. And I think the G7 was meeting. I'm pretty sure they were meeting today to discuss this. And so if a bunch of countries release some of their reserves all at the same time, you could change market sentiment for a week maybe and bring oil prices down several dollars, but it's not going to solve the supply disruption.
No,
if
but
it's ongoing.
Yeah, it's a buffer though.
There's even a crazy idea of what I heard that was being floated of Treasury intervening in the futures market, which is like a surefire way to throw a whole bunch of U.S. taxpayer dollars away. Very odd.
so Carl, you were mentioning that the tie between GDP and energy isn't as strong as it used to be. Is that still true with basically what I'm hearing with AI, right? The large energy needs by the data centers is increasing, but what I'm hearing from our industry, from an engineering side, is that they're trying to get away from oil, right? Looking at more nuclear, the mini nuclear reactors and other types of energy sources to kind of combat the large costs.
Yeah, and they're using LNG and building their own power plants, right? And in contrast to oil, LNG is a more localized market, just because it's so hard to move it, right? And it's not a completely localized market, so obviously LNG prices will rise, but not to the same extent that oil prices have. And again, it depends on where you are in the world. If you're in Europe, you're seeing surging LNG prices and surging oil prices, and their oil prices have gone up even more than ours.
And from construction side, I know that's at least on the mainland, what it's spurring is a lot of investment in infrastructure, because they said our energy grid is just horrible. And so, these data centers right now are sucking all this energy and creating problems. And I think there's an article in the Wall Street Journal that, a couple of the data centers kind of clicked off for a little bit and it almost wrecked the grid, right? So
yeah, I saw that.
So obviously, I think it's creating, opportunities from a construction side that there's going to be more need in the future for some of this. So,
Councilmember Bennett, you wanted to say something?
I would I was gonna just addressing to Mike's question is my brother is a retired Navy commander and he was in the Persian Gulf. He calls this the 1,000-year war. And it doesn't go away, but it gets hotter and cooler. And I really, to Carl's point, it's for me, it's how long are we gonna be involved and to what extent? And so the pattern in the past has been we come in and throw a few very big punches and then try to get out. And so that's what I'm hoping is going to happen in this scenario, if it's possible.
So do we have any motion for the fiscal year 2027?
Kind of like what Carl said, is to keep it as is, and then we can switch it come May or June in the future.
Would you like to make a motion, Councilmember Hamasu?
Motion to keep the existing forecast as is.
Second, any seconds?
I'll
I'll
second. Okay.
Any further
Well,
discussion?
Margie.
Okay.
Okay, Councilmember Bennett seconded. Any further discussion on fiscal 2027? Okay, we'll take a vote. Vice Chair Maynard,
Aye.
Dr. Bonham.
Aye.
Councilmember Hayashi,
Aye.
Councilmember Hamasu,
Aye.
Councilmember Bennett.
Aye.
So the motion to keep the forecast at the same level, 2.0 for fiscal year 27 is the vote is unanimous by the council. Okay, now we have the remaining fiscal years, fiscal year 28 through fiscal year 2032. Anyone want to start the discussion?
I'll let Christy do that.
I was trying to pull up foil charts and everything else.
I just took a quick look at the energy intensity of the U.S. economy and of the Hawaii economy, and basically, we're in the U.S. right now. We're using about 60% less petroleum per dollar of GDP than we did in the 70s, and in Hawaii, it's probably closer to 40 to 50% less.
Interesting.
Yeah.
Good news.
Yeah.
I mean, some of a huge piece of that is just you look at, you think if you remember what your mile per gallon was in your first car in the 70s versus the electric car you're driving today, and which you hopefully are charging with solar, there's an enormous, that's a huge difference. And then of course all the factories on the continent have also gotten much more efficient. Sorry to interrupt. Christy was about to tell us what the forecast would be for the out years.
I really don't know, but we had been talking about leaving everything the same. That's kind of a cop-out, but I'd be okay with that.
I mean, I don't think it's a cop-out. I think you change things when you have better, your information changes. And I certainly don't think that the information has changed all that much for the out years.
Mhm.
I mean, I guess if I were to think about something that was changing the out years, it might be the persistence of inflation and the rising federal debt. To me, those are things to worry about. But that's really more the very end of the forecast sample, I think.
Mhm.
And in theory, Carl, those were present when we made our forecast previously, right? So
Yeah, they're just a little bit different now, but not very much. You could actually get a big tailwind from all of the tariff refunds. All right. So the federal, the Treasury has to borrow more, so the 10-year bond rate might not do very well, but
Yeah.
that's a lot of money to throw back into the economy.
Any further?
Yeah, and then you also have. I'll be quiet. We don't need to keep speculating about the out years.
It's hard to be refined in the out years.
Yeah.
I'd be comfortable keeping the forecast.
Remember that all that variability in the forecast is coming from the tax revenue side, from the changing tax laws. So it's not, doesn't really reflect our above the line.
Well, that's a point if we could have some discussion. I thought I had read that the governor was and the legislators contemplating delaying some of the changes.
So that's right, that's not done yet. And as a general rule, we only take into account stuff that's already been signed into law. And you know, and there's been pushback from legislators. At least in my conversations with the money committees, I don't think anybody wants to postpone the tax cuts. I don't think the governor wants to. I don't think the money committees want to. And yeah, I don't know how it's going to come out. Presumably, it will be different than what the governor proposed.
Some of the credits are going to expire though, right? BBAR's in 27.
The extension, yeah. So you're referring to Act 163 SLH 2023. The EITC was expanded from 20% to 40% of the. So that's the Green Affordability Bill, the first one. So they came with a sunset date.
So that's on page 6, right? Of the
so that is already, yeah. So that is something that you had considered already, but that is also up for discussion. They can extend it. You know, that's part of the packages that Carl was referring to.
And that's in the below the line calculations already.
Yeah.
Yes, our forecast below the line assumes that those credits expire and therefore collections go up. So again, until the law is actually officially changed, we do not change our forecast.
Okay.
Correct.
Well, I don't know if Marjorie made a motion.
I can.
Okay.
I'll second.
What's the motion?
The motion is to keep the forecast for 2028 through, hang on a second here, 2032 as is, unchanged.
Any second?
I'll second.
Second. Anyone want to further discuss the forecast? Okay, we'll take a vote. Vice Chair Maynard?
Aye.
Dr. Bonham?
Aye.
Councilmember Hayashi?
You're muted, Scott.
Sorry, aye.
Councilmember Hamasu?
Aye.
Councilmember Bennett?
Aye.
Okay, so the vote carries unanimously for the fiscal years 2028 through fiscal year 2032. Okay, so next item on the agenda is the report by Budget and Finance for the non-general funds.
Good afternoon, Chair, Council members. This is Greg Hiratagoto from Department of Budget and Finance. We have provided you with our report of revised projections of general fund, non-tax revenues, non-general fund tax, and non-tax revenues since our January 7th meeting. These revenue estimates were prepared by departments in January through February, early February, and were based on point-in-time assumptions made by program and department staff. Our report includes a summary of the significant changes, and I will highlight a few of the more significant changes. Let me share my screen. Are you able to see my screen yet?
Oh, not yet.
It's coming.
Okay.
Yes.
Yeah, yes, we can see it now.
Okay, so the first one is on table 2A. I like to highlight non-revenue receipts. There is a increase in FY26 that is based on actually a litigation settlement between the state and a pharmaceutical company, which was
Wow.
about $557 million.
Okay.
And that's from general funds. And the next one, actually, we don't have too much to highlight this update. So it would be the table 5A. Under the federal grants, we actually have a increase in federal grants from FY26 through FY30. And this is mostly, well, it's partially due to a new grant for, I guess it's the rural health transformation program that was awarded to BNF and will be implemented through Department of Health and Human Services
Great.
in the state. So, and actually, that's all I have to highlight this update. So,
Any questions of Mr. Hirohata Goto? Okay. Is there a motion to approve the report by Budget and Finance?
So moved.
Okay. Any second?
Second.
Okay, we'll take a vote. Vice Chair Maynard,
Aye.
Dr. Bonham,
Aye.
Councilmember Hayashi,
Aye.
Councilmember Hamasu,
Aye.
Councilmember Bennett.
Aye.
Okay, so the motion carries unanimously to approve the report by Budget and Finance. Thank you, Mr. Hirohata Goto.
thank you.
Okay. Okay, is there any, I guess the next item will be the next meeting, right, for general fund?
Right. And Greg, just to be sure, your screen sharing is still ongoing. Okay. It's still you're still sharing.
Okay. So the reporting date for the next general fund is, Baybars, it's June 1st, right? You
No,
said?
it's good. Yeah, the reporting is June 1st, and you know, we typically, as I was saying, do it sometime in the last 2 weeks of May, depending on your schedules.
I know we're varied, from kind of like the
Yeah,
report, but we usually try to give you at least about 3-4 days at a minimum to get the
right,
report.
right.
Any proposed dates? It's right around Memorial Day weekend.
So if you prefer it before, like that would be sometime, let's say May 21st is a Thursday, and then the following week, May 25 is a holiday, Monday, Memorial Day. So it can be after that if you want, or it can be before that. We're okay with either way.
I'm a little bit more free on the week of the 18th.
Okay.
How's the 21st at 2 p.m. to keep our traditions alive?
Yeah.
I can
That
do
works for
that.
us.
Is May 21st at 2 p.m. okay for everyone?
Yes.
Dr. Bonham, that's okay with you? Okay. Okay, so the next meeting will be May 21st at 2 p.m. Okay. Yeah, I think that's all for the public session, unless there's any other business. And I think, Baybars, I think we wanted to have you explain to Dr. Bonham about why the stats aren't, might be different from the daily.
Are we allowed to do that?
Are we allowed to discuss it off the record?
I don't know. You tell me.
Uh,
I think I understand what Baybars was getting at. The interesting thing is that no one's ever explained it in those ways in the past, even though I have been asking about this for a good decade and a half. And
You
it
never asked
sounds
me.
like what you're saying is that the data you share with DBED for their monthly spreadsheets is not just the general fund, but it includes all of the data. I think that's what you're saying.
That is
And
correct.
so I guess I would have two questions. One is, why isn't that data being published on your website? And because we're offline, right?
No, we're not
No,
offline.
you were asking,
Oh.
you're questioning if we could go offline.
Okay. Yeah, so you and I can talk about that offline.
Yeah, so
think.
I said I would explain. No, we do have all the data. I don't know what was your basis, but yeah, I'm happy to. I said we've been providing data to DBET and like clarified their data needs, and same thing would hold for UHERO. So yeah, please,
Yeah.
please let's talk about
I'll
that.
ask our data guru to reach out to you.
That would be great.
I would
Thank
be
you.
I would be
Could you
interested
give us
in hearing that as well, because we rely heavily on the tax department data for our forecasting.
Yeah, same thing. Like, please do reach out to me. I'm happy to, you know, I guess one-on-one I can explain. We do disseminate quite a bit of data, so I just want to make sure everybody's clear about what data we share and what it means.
So Mike, if we get the data, we're going to put it in our data portal, assuming we have permission, and I think we will
Sure.
because DBET puts it up.
Sure,
And
sure, sure.
And if you want to access it with an API, you can let us know. We should be able to provide that. Or you can pull it from DBET spreadsheets.
Well, that's what I've been doing historically, is go to DBET
Yeah.
spreadsheets and pull it, but like you mentioned, it's 4 or 5, 6 months later, then it doesn't provide much of a.
So yeah, so I've implemented you know, some strategy where whatever is available is now shared much faster with only a month lag. The general fund takes a little longer, so that's why for that one we rely on the preliminary numbers. But like the individual income tax, TAT, GET, those numbers we release pretty much like just like the same time you would get the preliminary numbers, you could get it with just a month lag as opposed to 3-4 month lag.
So
So
Bob
we have
Irish,
made
how
it more
about if
efficient.
we have a quick Zoom sometime in the
Yeah,
next few weeks, and we can
Anytime.
invite whoever from the council wants
Yeah.
to attend.
If you could send out maybe an invitation to all the members, because I think we're all interested in knowing what the differences are.
yes,
Yeah.
I'll be happy to.
Okay.
And then that way we can check to make sure we're not violating any rules.
Yes.
Yes,
I don't think we are, as long as we're not talking about the forecast.
that is my understanding. Yes.
Because I know historically we've had like trading offline.
Right.
Yeah.
Okay.
Okay.
Thank you, everyone.
Thank you.
Thank you.
Okay, cross your fingers.
Thank you.
Hey,
Yes.
What is the reporting date for this? It's the 15th.
Reporting date is the 15th,
So you try to get the letter to us tomorrow.
tomorrow.
Okay,
Yes.
great. Okay,
Thank you.
thank you.
All right.
Thank you.
Bye.